Imagine you have exactly $500 a month to invest, or $6,000 sitting in savings right now. This chart compares your two options, trickling money in slowly or dropping it all in. Strategy A is dollar cost averaging. You set an automated transfer the same day every month. Strategy B is lump sum. You take that cash and buy in immediately. Pick the entry method that aligns with your cash flow and your personal tolerance for risk. Most people freeze up right here. They are terrified of buying immediately before a market crash, so they decide to wait. And while they wait, inflation quietly eats away their purchasing power. But a century of empirical data proves that the stock market reliably trends upward over time. By sitting in cash, you might dodge a temporary dip, but you miss out on decades of compound growth. Getting your money into the market today is far more important than guessing when to enter. This bar chart shows the results of a Vanguard study. It proves lump sum beats dollar cost averaging 68% of the time. The math is straightforward. Because markets usually rise, deploying your cash on day one maximizes your exposure to those gains. If the market rallies the day after you invest $6,000, your entire stack starts growing immediately. But if the market tanks right after you buy, you take the hit with no cash left to buy the dip. Over 30 years in a Roth IRA, a $6,000 lump sum historically grows to about $110,000. The math favors going all in, but it requires serious emotional discipline to watch your savings drop without panicking. That is exactly why dollar cost averaging exists. It takes human emotion completely out of the process. This graph illustrates the pricing mechanics. A fixed $500 investment forces you to automatically buy more shares when prices drop. And when the market gets expensive, that exact same $500 naturally buys you fewer shares. Look closely at this trading floor index from March 2020. The Dow dropped nearly 3,000 points in days. While lump sum investors panicked, automatic monthly buyers kept accumulating cheap shares, capturing the full recovery 5 months later. DCA yields slightly less over 30 years, 102,000 instead of 110. Think of that difference as an insurance premium against panic selling. But your entry timing is completely irrelevant if you pick an expensive investment vehicle. This scale shows an index fund charging a 0.03% fee versus an actively managed mutual fund charging a full 1%. That 1% fee sounds harmless, but over decades, it quietly drains tens of thousands of dollars from your compounding returns. Keep your fees near zero. An optimal entry strategy means nothing if high costs devour your profit. Sometimes you receive a sudden influx of cash, like a performance bonus or a large tax refund. If going all in stresses you out, use the hybrid strategy. Split that cash right down the middle. Deploy 50% today to capture upward trends and automate the remaining half over the next 6 months. You secure a baseline market position immediately while preserving emotional stability and dry powder for near-term dips. This flowchart breaks down exactly what you should do, based purely on how you receive your money. If you rely on a monthly paycheck, automated dollar cost averaging is your only mathematical and practical option. In fact, if you contribute to a 401k at work, you are already executing this strategy every single pay period. If you receive a windfall, pick lump sum if you tolerate risk, or the hybrid method if you get anxious. The validity of a strategy is determined purely by your ability to stick to it when the market drops. Open a Roth IRA today. Automate a $100 transfer for the first of every month and walk away. Once a year, systematically increase that monthly contribution by 10% to accelerate your compounding growth. Obsessing over minor differences between winning strategies is exactly what keeps people stuck sitting in cash. Time in the market will always be trying to perfectly time the market. Financial success belongs to the consistent action taker. Stop overthinking your entry and just start. You have thousands sitting in a bank account. You want to invest, but the fear of picking the wrong day keeps you frozen. You have to choose between two paths: drip-feeding that cash into the market over time, or putting it all in today. Over 30 years, this projection shows a lump sum growing to $110,000, while a monthly plan reaches $102,000. That $8,000 difference is marginal when you consider it represents 3 decades of growth. Deciding between them isn't about finding a perfect formula. It is about looking at your bank account and your tolerance for risk. A mathematically optimal return is useless if the strategy makes you so anxious that you sell your positions during the first market dip. Research from Vanguard shows that investing everything at once beats spreading it out 68% of the time. Because markets generally trend upward over long periods, getting your money to work early allows it to capture more of that growth. However, if a severe correction happens right after you invest, the emotional pressure can be difficult to manage. It is easy to look at a historical spreadsheet and feel confident. It is much harder to watch your actual savings decline in real time. A strategy only works if you can actually stick to it when the market becomes volatile. Lump sum investing is simple. You deploy 100% of your available cash on day one to maximize market exposure. The risk is timing. You could invest your entire savings right before a global event triggers a sudden downturn. In March of 2020, the Dow dropped over 1,000 points in a single day, marking the start of a 34% decline. If you have already invested everything, you are forced to wait for a recovery, without any cash left to buy more shares at the new lower prices. This initial shock often leads to realized capital loss, as the fear of further drops drives investors to sell at the bottom. Dollar cost averaging, or DCA, is the process of buying a fixed dollar amount on a set schedule, regardless of price. This chart illustrates the process. When prices dip, your fixed dollar amount buys more shares at lower prices. During the 2020 recovery, those extra shares purchased at the bottom helped portfolios regain their value faster. Automation shifts the responsibility from your willpower to a preset schedule, making it easier to ignore daily financial headlines. For most people between ages 22 and 40, a bi-weekly paycheck is the primary source of investment capital. DCA is a reliable method that matches the frequency of your paycheck to build wealth over time. If you have a sudden windfall, like a tax refund, you might still feel paralyzed about when to enter the market. The hybrid strategy offers a middle ground to help you move past that hesitation. Take half of your windfall and invest it today. This puts a significant portion of your money to work immediately. Then, schedule the other half to be invested in equal parts over the next 6 months. This approach gives you immediate market exposure while providing a psychological buffer against a sudden, short-term crash. While entry strategy is important, what you actually buy matters more. High management fees are a constant drain on your progress. Compare the cost of a basic S&P 500 index fund to an actively managed mutual fund. This diagram compares the costs. An S&P 500 index fund has an expense ratio of 0.03%, while mutual funds charge 1%, 33 times more expensive. Over 30 years, that 1% fee compounding consumes nearly 1/3 of your total potential returns. Debating between a lump sum or DCA is less important than ensuring your money isn't being lost to high fees. Your choice should be based on your current cash flow rather than market predictions. If you are investing part of your salary every month, automated DCA is your best path forward. Set your contributions to occur on the first of the month and try to increase that amount by 10% each year. If you have a windfall sitting in cash right now, the 50-50 hybrid split is a practical way to start. Choosing the strategy that fits your liquidity removes the stress of decision-making and helps you start building wealth immediately. A common hurdle is staying out of the market entirely while waiting for a perfect dip that may never come. Historical data shows that the total time your money is invested matters much more than the exact day you started. After 30 years, the small differences in entry timing become less significant compared to the total wealth generated by compounding. Both methods are effective for building wealth. The biggest risk is staying on the sidelines and doing nothing at all.